Mr. Vijay Chandok is also joining us of ICICI Securities. So let's actually start off with that. In fact, on ICICI Securities, they've seen a surge in retail trading volumes, and we look forward to talking to them also of the trends in the retail segment and an outlook going forward as well. Mr. Chandok, good morning. The lockdown, of course, has translated into higher investor activity within the retail space. What is the kind of trend that you're observing?
Yeah, good morning to you. Good morning to all the viewers. And thank you for having me on this show. Well, certainly, like as you said, I think clearly a few things coming out. One is retail participation is increasing and it's very buoyant. When you look at the average daily turnover on the cash equity side, in the markets, that's up by about 50%, by about 40%. For our firm, it's a little higher than that. So we've been seeing a very strong retail participation coming in. Secondly, when we look at another interesting feature here is that a number of dormant customers that we had have started becoming active. So if I compare, sequentially, about clearly a 20-25% uptick is there in terms of a number of people. And when I compare it with a slightly older period, it's actually more than 50%. So that's the other trend we are seeing. A third very interesting area that's seeing development is that the number of customers who are comfortable getting onboarded or acquired digitally on platforms like ours has started increasing. We've actually doubled the numbers post the lockdown. We earlier used to run a physical plus a phygital model. We've completely transformed ourselves to be a completely all-digital model. And those are the numbers which have started increasing. Also, a number of investors who probably are not as digitally savvy, they are quite happy to get onboarded on what one can call as an assisted digital. So they are happy to get guided to begin with on a telephone call, do their bit, get onto the platform, and then slowly learn their way around and then start becoming sort of self-directed in their own way. So these are some of the areas, some of the trends that we are seeing in the markets just now amongst the retail investors.
All right, fair enough. Do you see investor interest, sustain going forward as well? What's causing the kind of strong traction that we've seen even at a time like this? And what's the kind of increase that you've seen, in the last couple of months, even in terms of volume?
Yeah, so I think if you look at the reasons, as recent as a few sessions before we went into a lockdown, the markets were, virtually hitting all-time high. Nifty was around 12,400 in that region, 12,000 plus. And in a very short period of time, we saw a very dramatic correction. The few sessions market crashed close to about 7,500 on the Nifty. That's about 40% off the table. So when investors did see this volatility, see this valuations of fundamentally very strong, I would say players, historically very strong players coming down so dramatically in terms of valuations, many companies hitting their multi-year lows, they found these perhaps activities, these levels pretty attractive to enter. Secondly, in terms of behavior, we also see that whenever times are volatile, the investors who are regular traders, they tend to get hyperactive. So volatility has led to their participation in a more vigorous way. And then you also have another set of investors who one can call them as traditional measured investors. They are not into the market on a daily basis, but they are the investors who are sort of doing their own fundamental analysis and then taking a position on us in a certain counter, certain stock, and then gradually building up a position. So these are players who suddenly find that their assumptions are going awry, their portfolios need to be rebalanced. Sometimes they are seeing an opportunity to exit certain counters or even take positions in certain counters. So they are sort of entering into the market who otherwise are more measured. And then finally, the third segment, which are people or investors who always wanted to invest in the markets, but somehow missed the opportunity because markets ran up. Find themselves in a very interesting spot where markets are down, multi-year lows, using this opportunity to enter. I would also believe the fact that many of them are working from home. In fact, all of them are working from home, and particularly in the month of March and April. Probably gave them time to think about, reflect on, and also time to look at the opportunities that the market is offering. So it's, I believe, a combination of all these things: the sharp correction, availability of time, assumptions going awry, the volatility, all this contributing to active retail participation.
Okay, now good news is that participation, activity, number of accounts have gone higher. But have brokerage rates also gone lower? Because when you have a disruptive player like Zerodha, who's created a geo moment in the brokerage industry. So one side is the amount we talk on, our telecom usage has gone higher, but ARPUs had collapsed when that had happened. So what is happening on the brokerage rate front?
So, clearly, when you look at yield on brokerage is certainly going southwards. However, when you look at the aggregate ARPUs at a customer level, I think ARPUs at a customer level for people like us, particularly people like us, who are, I would say, a broad-based player. What I mean by this is it's not just about equity business for us. We are there across the spectrum of investment place. But in addition to that a player like us is also one can call playing the entire life stage needs of an investor. So moving more beyond investing and not just staying in investing and moving into, it's the same investor eventually who's looking for protection. That's another large underpenetrated market. Life protection, health protection, asset protection. I think these are areas that our customers look for, and we are able to provide them digitally through a network of partners that are providing these needs for them. And we are also moved quite actively into meeting the borrowing needs of investors by tying up with our partner ICICI Bank for distributing their loan products. So it's fundamentally spanning life stage needs, financial needs, digitally delivered, and through an open architecture platform that we are doing. So for a player like us, it's a diversified play, and it's getting more and more at an ARPU level rather than an yield per product.
More digitization means better yields and better realizations for you. Business coming back means operating leverage would kick in. And see, with fixed deposit rates coming down and with banks offering less yields on their bank deposits, one would imagine that the migration to equities and migration to debt products or mutual funds will only increase. So the COVID crisis in a sense has really benefited you.
I think there are, I would say, at least 2-3 trends which are in favor of people like us. Digitization, as you correctly said, increasing outcomes of behavior changes leading to perhaps greater diversion towards savings as an asset class. So when savings tend to sort of take center stage, it benefits players like us. And even before we came into the COVID, we started seeing in this industry some degree of consolidation taking place. I think all these are in some sense structural tailwinds for a firm like ours.
All right, thanks so much for joining us this morning. Let's take a very quick break on that note. That's the latest coming in from ICICI Securities.